Welcome to Fitch Ratings Fixed Interests Podcast. My name is Justin Patrie. The private credit market continues to garner significant attention, growing by hundreds of billions of dollars by some estimates in 2024. To discuss private credit, I am very pleased to be joined today by a return guest, Meghan Neenan, head of North American non-bank financial institution ratings. Meghan, we last spoke in April last year. What were the most notable developments in private credit over 2024?
Well, first, Justin, thanks for having me back. Two things I'd probably highlight. One is the growth in asset-based finance, which is expected to be the biggest driver of private credit expansion over the next several years. So this is coming from a couple of places. One, bank partnerships and flow agreements with investment managers. With ongoing regulatory change in the banking sector, banks are looking for ways to be more capital efficient. So we're seeing them increasingly partner with investment managers to move certain assets off their balance sheets, which in turn reduces their capital requirements. There are examples like Blackstone and KeyCorp. They entered into a flow origination partnership related to specialty finance originations. Lloyds Bank also formed a direct lending partnership with Oaktree to finance UK-based middle market sponsor-backed borrowers. In these instances, the banks can retain the interface with the client and retain the relationship, but the assets originated are held by a fund the investment manager oversees. This way, the bank is still there to provide ancillary services to the client, like derivatives, etc., which is not something the investment managers want anyway. So that can be a win-win. We've also seen the outright sale of some businesses by banks. So Carlyle and KKR partnered to purchase a student loan portfolio from Discover. Apollo bought a significant portion of Credit Suisse's securitized product group. And we do expect to see more of these partnerships with the banks in 2025, particularly as the regulatory landscape continues to evolve. But also within asset-based finance, some alternative investment managers are going right to the source and creating their own origination capabilities by purchasing the originators outright, either through funds and or with their insurance company affiliates. So Apollo is an example of this, and they own more than a dozen origination platforms. Strategies include middle market corporate loans, warehouses, fleet leasing, aircraft, trade finance, etc. These origination platforms create assets in which Apollo's limited partners can invest, so that is also fueling private credit business expansion. The other development I want to highlight is what's being called the democratization of credit, or private credit's continued penetration of the retail market. So in 2015, Blackstone launched a perpetually private real estate investment trust known as BREIT. This vehicle was not intended to ever go public. It receives monthly inflows from retail investors, and in turn provides investors liquidity via a quarterly redemption option capped at 5%. In 2021, Blackstone took this same fund wrapper and introduced a perpetually private business development company, or BDC, known as BCRED. Both vehicles raised a significant amount of capital in a relatively short period of time, so other managers quickly followed suit with their own offerings. Now assets in perpetual structures account for over 40% of BDC assets in just 4 years. And we've seen this structure replicated further with other collateral types like private equity, infrastructure, secondaries, etc. And we also saw the announced partnership between State Street and Apollo to look at the creation of an ETF with private asset exposures. So because the retail market continues to be viewed as an underpenetrated investor group, we're going to see continued asset growth and product creation in that space.
Okay, a lot happening in 2024. So looking forward now, we're already in 2025. What do you see for North American private credit loans in terms of credit quality, and what are the key factors driving your views?
Yeah, here we tend to focus on direct lending, the direct lending piece of private credit, which according to Preqin accounts for about 50% of AUM. Direct lending is largely comprised of sponsor-backed commercial loans, and Fitch has some insight into this market from its ratings on 30 BDCs and its privately monitored ratings portfolio, or PMR portfolio, which is made up of over 300 credits. We also provide credit opinions for over 900 issuers, which are in middle market CLOs, and have insight into their performance as well. On the BDC side, we definitely saw more credit differentiation in the portfolio in 2024. Average net realized losses were up just about 20 basis points in the first 9 months of the year to about 0.9% of the portfolio at fair value. But the range of performance was net realized gains of 1% to net realized losses of 4.3%. So a big difference there. For 2025, we're expecting to see more realized losses in the BDC space as interest rates remain elevated, even with some recent rate cuts. On the PMR portfolio, the backdrop of modest interest rate relief and GDP growth should benefit the default rate as the year progresses. The default rate ended the year at 8.1% in 4Q, and that's up from around 3% at the start of the year, with defaults somewhat evenly spread throughout the year. Downgrades often outpace upgrades in Fitch's PMR portfolio due to the limited upward rating mobility, just given the borrower's small size and lack of diversification. However, absent major policy missteps, the pace of downgrades could slow in 2025. Since 2023, the downgrade to upgrade ratio has hovered around 2.6 times, but it could start trending back downwards this year. Fewer than 12% of issuers in the portfolio carry negative rating outlooks, and that's down from nearly 15% at the end of 2023. So that should also be supportive of a more favorable ratings trajectory.
And what are some of the key risks or the major things you think about regarding these views regarding private credit loans and credit quality? Do you have any scenarios or variables that you're keeping particularly close attention to?
I mean, rates, the economy, and the labor markets. Some recent rate cuts have been incrementally helpful for credit, but expectations for further rate cuts have now been watered down for 2025. So there's going to be a number of credits that continue to have interest costs well above underwriting cases, and that will certainly pressure credit performance, particularly for investments on watch lists and on non-accrual status already. We've also seen an increase in structured paid-in-kind income, or PIK, over the last couple of years, with a number of private credit deals including PIK toggle options for a period of time, typically 2 years at origination. If we see more borrowers electing to exercise that option, that would have a negative impact on cash earnings and could result in higher losses down the road if companies run into trouble. The strength of the economy, labor, and inflation are also certainly watch items. BDC portfolios, for example, tend to be more heavily exposed to business services and healthcare, so labor costs can definitely have a big impact on EBITDA there.
Now, you've mentioned BDCs, business development companies, a couple of times now, and they make significant investments in the private credit space. And we have a deteriorating sector outlook for BDCs in our 2025 Outlook series. Can you explain our views for BDCs?
Sure. Yeah, our deteriorating sector outlook for BDCs in 2025 really reflects expectations for a very competitive underwriting environment. We also expect to see additional non-accruals and realized losses across portfolios and weaker net investment income and dividend coverage, as rates will be lower year over year. We're also focused just on the uptick in unsecured debt maturing in 2025 and 2026, although rated BDCs had record unsecured issuance in 2024, and this year is already off to a strong start. So they are consistently pre-funding upcoming maturities. Still, to the extent there's any kind of market dislocation and BDCs have to refinance some maturities with secured debt capacity, that would negatively impact their funding flexibility. We do expect average leverage could rise with increased origination activity in 2025, assuming M&A picks up as expected. However, we think asset coverage cushions will remain sufficient to absorb additional realized losses and or declines in investment valuations. That said, from a rating outlook perspective, we are largely stable. Fitch rates 30 BDCs publicly today. 28 of those have a stable rating outlook, and 2 are on positive.
Thank you, Meghan. My last question. There's been some discussion in the wider market for some time, including from some international financial institutions, about the broader systemic stability risks from private credit. I've read reports where there's a focus on the illiquidity of the asset class, its growing scale, stale valuations, and other potential issues. Does Fitch have a view on the broader systemic risks from the growth of private credit?
Sure. It's definitely a complex topic as the market is evolving at a rapid pace. The bottom line is we don't think private credit in isolation poses a systemic risk today, but there are certainly things developing to keep an eye on. First, on the illiquidity of assets, a large portion of direct lending private credit assets are in permanent capital vehicles, PE-style drawdown funds, or open-end funds with redemption caps and or the ability to gate. Therefore, we don't expect there to be the need to force sell assets in the majority of cases. That said, we do see a continued evolution in fund structures and collateral. I mentioned asset-based finance and open-end structures for retail investors, and it's critical to monitor redemption terms, fund cash flows, liquidity management, leverage relative to the risk profile of the assets, funding maturities relative to asset duration, and the quality of the assets, including the impact of competition on loan pricing terms and conditions. Additionally, we're seeing growing interconnectedness between the largest alternative investment managers in the world. The largest 9 that Fitch rates had $5.1 trillion of aggregate AUM at the end of September, and they're frequently partnering on private credit deals and providing financing to each other's private equity deals. We're also seeing increased exposure to private credit assets in life insurance company investment portfolios. Those U.S. life insurers that have an affiliation with an alternative manager, either through a minority stake or outright ownership, have on average 4 times the exposure to level 3 assets in their investment portfolios than unaffiliated life insurers. Those level 3 assets are not actively traded, they don't have a readily available market quote. So the growth in insurance affiliations has increased the regulatory focus on related party transactions and potential conflicts of interest. The U.S. supervisory oversight body, the NAIC, is keenly focused on the expansion of private credit in the insurance industry. In addition to demanding increased disclosures, it's also looking into private ratings received from the various credit rating agencies, as those ratings are inputs into the regulatory capital models. Finally, I mentioned some of the connections with the banks before, but banks are also often providers of financing to private credit firms and funds. The exposure is hard to size given the lack of disclosures, but beginning with the December 31st, 2024 Bank Regulatory Call Report data, U.S. banks will be required to report more granular information on exposure to the non-bank sector, separated now by 5 new lending categories. And Fitch believes the enhanced granularity will provide more insight into concentrations and potential second-order effects from credit and liquidity risks within private credit. So long story short, there's a lot to watch in private credit.
Well, thank you very much, Meghan, for sharing your thoughts on private credit. And as always, thank you very much to our listeners and subscribers. If you'd like to learn more about Fitch's credit ratings and specifically our credit views and extensive research on private credit, please visit our website at fitchratings.com, and you can go to the top and click on private credit, where you will see all our research that we've published.